All right, I think we can go ahead and call the meeting to order. You want to do the roll call?
Absolutely. Laura Balin, Landon Moore,
Present.
Mark Gardner,
Present.
David Hawley,
Here.
Mark Munson, Danny Covey. Cheryl Spivey. Here. Elizabeth Gooden. Derek Challenger.
Here.
Shannon Glover.
Here.
We do have a quorum. No, we do not.
No, we just have three.
We just have three.
No, she didn't.
Oh.
She didn't call me.
Harrington.
You do. Thank you.
Okay, yes, David Harrington.
There you go.
He's here.
We do have a quorum.
Thank you.
Thanks for that.
Next item on the agenda is the approval of the minutes from the prior meeting. Has everybody had a chance to look at those? Do we have any comments?
Move for approval.
Second.
All in favor?
Aye.
Aye. Anybody not in favor? All right, the minutes are approved. The next item is applications for retirement. It looks like we have one on page 4 here.
So that's the one.
This is just for information purposes. We don't have to.
Right,
It's not
right.
an approval item.
You know him?
That's right.
Joan.
We had one death.
One death.
No applications for retirement, no, in either system, and one death. John Boaz, and our active participants are 14 in each system. So active participants are people who are still working, down to 14 in each system.
Okay, thanks.
One of 14.
Next item is the fund flows. Out of order.
Okay, the page before the one that has the applications for retirement, the fund flows. So for August, we began with a beginning balance of $212 million. We had some interest income of $39,200. The reoccurring payments out, which are the contributions, were $2,451,672. And this month we had an unrealized loss of $2,661,098, which brings us to an ending balance of $206,940,630. I will, in addition to that, I will say the city made its first quarterly contribution in October, so that will show up. But that has been made and it has been received by John Hancock.
Correct. That's like a couple million.
Oh no, it was
Usually,
none.
yeah.
No, well, yes, that's about right.
Yeah,
Yes.
it was, I think 2.2. I have
Now, is
the
that included or not included?
It
in
is
this?
not included.
Okay,
Those
all right.
that
Thank you.
contribution was made.
Okay.
Yes, in October. Yes. And so it's a quarter of the budgeted contribution for the year, which is very close to $10 million.
Right.
Yeah, so it was 2.6 million approximately.
Okay. Any questions about that? No? Okay.
Excuse me, I did have it. So is that roughly a quarterly payment? Is that 2.6 million per quarter?
Yes, yes,
Okay.
that will be per quarter. And that is the amount budgeted.
Yes, ma'am.
And you'll get some, one of the next items on the agenda will show the actual, the contribution that has just recently been determined. And
Yes, ma'am.
so we can talk about that after that's presented.
Thank you.
All right. The next is an update on the OPEB trust. The statement is in here for the month of August. If anyone has any questions about the statement, we can take those now. Otherwise, if no one objects, I'd like to move the agenda item in new business B, an update on the OPEB trust for now. They had, so I attended the meeting, the annual meeting of the Pooled Investment Trust. I have a few slides if you flip forward all the way to the back here. Page 34 on mine.
It looks like that, right?
Yep. With the bubbles. So this meeting is annually as an update on this pooled trust. Other municipalities and government entities, just like Portsmouth, were represented there. I don't have the list of participants, but it's quite a few other counties and cities that you'd recognize. I've got on the next page just some very high-level information about the OPEB trust and what it is. I know everyone knows what it is, but it doesn't hurt to sort of review that for any new people. So this trust is administered by this entity, the VML VACO Finance, which is a combination of the Virginia Municipal League and the Virginia Association of Counties. They came together in 2003 to establish this trust to help municipalities like us. And the main benefit there is, our piece of the pie is only $5 million. There's from an investment management standpoint, you can't get the level of service and professional management with that much money. So pooling together the counties and cities' money, now they have $1.2 billion in assets, which is good size assets that they've been able to get some professional management of the pool that otherwise you wouldn't have, and the scale also allows for fee reductions with the investment management fees. The average funded status of participants in the trust is about 47%. My sort of back of the envelope math has us a little bit lower than that, at about, I think are we about 25%? I think I thought I had it on here. We've contributed $4 million since 2018. I think the liability is about $20 million.
Yeah, you have it where it says funded status, I think, down here. Is that what you're talking
Page
about?
before
On
that.
the page before that, where it says funded status,
Yep.
20%.
Okay, I'm missing a page.
This right here, do you have this?
Sorry.
No, I don't.
Here, you want?
Here, I have another one.
There you go.
Okay, there we go. Okay. Yeah, it's about 4 million against 20 million, so we're a little bit lower funded than other municipalities, but we just started, so we're playing a little bit of catch up. I don't know what the city's long-term goal is. I think it's to fully fund it.
That's, and the way the city is handling it right now is we're paying all the claims as they come in without using the trust. So we're paying claims and we're making $1 million contribution to the trust. So at some point, doing it that way, once we have fully funded the liability, then the city would not have to pay the claims as they come in. The claims would be paid from the trust. But as we said, this is just we've had 2 years in, we're getting ready to, we're in our 3rd year now, so we'll make another $1 million contribution. We've been making that in the spring, which will bring us a little closer. But as long as the city is paying retiree health claims as they come in without using the money in the trust will only continue to build until it can get large enough to be able to pay the claims out of the trust. Does that make sense?
Does the city, on a retiree, does the city cover the cost of health insurance for the retiree? What is the health care cost or benefit here?
If they qualify, retirees have to have met, a length of service requirement.
Right.
And then, and that has gotten, the length of service required has gotten larger over time. So for instance, someone who came into the city at my age, the city would never be covering me for health care. But those who are covered, yes, we cover theirs. They make they
This is
pay
any city employee?
that met the requirements.
Okay, all right. And the health care cost, or?
I don't have that number with me, but I can.
I don't mean number, I mean, does the city pay for their health insurance premium, or?
They pay their premium, and we're self-insured.
Okay.
So we're paying the claims.
Okay,
A premium is computed. I believe our Human Resources Department uses a consultant to help to compute the premium, and
so the retiree
is paying a premium.
co-paying premiums?
Yes, they're paying.
Or paying the whole premium?
They're paying their monthly premium or their bi-monthly.
This
premium.
cost is for the claims against that?
And this,
Okay.
yes.
Okay, yeah.
David, as an example, I can tell you a single retiree pays around $570 a month
Okay,
premium.
all right,
And it goes up quite a bit from there to the family level.
It was more than the actual.
okay. All right, and that money is currently funding any benefits that are being paid out?
That plus what the city is contributing as well. The premium is not fully funding the.
Okay, but that's where the
The
premium
claims.
dollars are going to?
Absolutely, yes.
Okay,
The premium
all right.
dollars are going into
All right.
into that fund,
To the self-insured?
to the
Okay,
self-insured fund.
Gotcha,
Yes,
okay,
sir.
thank you.
All right. Flip to the next page, which I was talking about because I was missing the background page. This is where you can see one comment before that. So this concept of paying claims out of the trust, hardly anybody's doing that. That's a part of this trust right now. So we're not an outlier. Again, you saw that the average funded status is 47%. So people are, I guess, are similar to us as they're trying to get better funded before pulling any of the money out. But so the next page, which I already covered most of this, 1.2 billion of assets, 47% funded. Their advisor is they have a small staff that of people that administer this trust. among some other things for the Virginia Finance company. But they have, they use this company called Asset Consulting Group as the main advisor on the policy and the asset allocation and the investment policy. I'm not familiar with them. They presented at the meeting, and you know, they seem to be a reputable investment advisory firm, and the results that are on the next page, they've done pretty well so far. Not great, but okay. Again, on here, the city's contributed $4 million. It was $3 million in 2018, and I think or 17, and then $1 million last year. You flip to the next page. This trust has two options of how you invest. It's Portfolio 1 and Portfolio 2. A simplified, a little bit oversimplified way to explain it is Portfolio 1's the slightly more aggressive asset allocation. It's about a 70-30 equity bond mix. It's not exactly that. They have a little bit of real assets. And then the Portfolio 2 is more like a 60-40 equity bond mix. The expected return on the Portfolio 1 7.5% versus 6% on Portfolio 2. Almost all the assets are in Portfolio 1, so we're pulled together with most other municipalities that have chosen that, which is from a long-term investment standpoint. I mean, this is a long-term liability. I mean, I think that's appropriate that we have that selection.
And Landon, is that a decision that we as a board make or the city makes as far as what portfolio we want to be in?
I would think that's the board's decision.
It is the board decision. We formed, when we joined,
Yeah.
it was the election that was made at that time. And the election was for Portfolio 1.
But at
And that
some
was the
time in the
decision.
future, if we choose to go to Portfolio 2, we have that availability to do that or not?
I don't know
Okay.
whether or not we have the ability to change it. I just knew it when we started,
I'm
we
just
had the
wondering.
ability to.
Yeah, okay.
I would think we can. Do you want us to ask that question? Do you want us to check on that?
If you think about it, yeah, it's not all that earth-shattering.
Okay. The only other thing I had was this is just some very basic performance information. Over the year-to-date and one-year number, the portfolio is lagging its benchmark a little bit over the 3 and 5 years. These numbers are net of fees. So in the 3-year period, they've covered their fees plus an excess of 16 basis points, and over 5 years, they're just short of covering their the investment fees. And then below that, the strategic asset allocation is a little bit more detail on that. And that's it. The meeting, as I said, the investment advisor, Asset Consulting Group gave a brief presentation, and that was kind of it. They voted on new board members, and that was a wrap. Any other questions about OPEB Trust?
I appreciate you representing us. Thank you.
You're welcome. I think the next agenda item is appointing Ms. Dora Jaje to as Executive Secretary. Do we need a motion to?
So moved.
Second.
All in favor?
Aye.
Any nays? All right,
You're on
new
board.
Executive Secretary.
Thank you for no nays.
And last but not least, we have John Hancock here to present on the actuarial update Andre Stewart and Tom Shanley. Take it away.
Take it away. All right, thank you. So thanks for having us in again. I'll be presenting from this binder with some funky color on the front. And I usually start by providing a brief overview of the retirement systems, the provisions, then definitions of some of the actual terminology that I'll be utilizing, and then launch into the nuts and bolts of the results. But as per usual, please feel free to interrupt with any questions or comments that you have as throughout this discussion. So on slide 4, just a history of the beginnings of the system. So the fire and police system became effective January 1st, 1957, and participation in that system was frozen June 30th, 1995, meaning that no new employees would enter the system to participate, but those who had previously entered will still accrue benefits. Similarly, under the supplemental system, it began in 1953, and participation was frozen at the end of November 1984. Current hires in each that would have participated in each of the respective systems now participate in the VRS. There are benefits associated with service retirement or normal retirement in the fire and police, ordinary disability in both plans, as well as service-connected disability and service-connected death in fire and police, as well as ordinary death benefits. On to slide 4. Retirement under fire and police, the eligibility is with 20 years of service or age 50 with 5 years of service. The monthly benefit is based on monthly compensation, and we determine an average of monthly compensation by looking at the highest 36 months received consecutively and taking an average of that. The benefit is a percentage of that average compensation determined by years of service. So a participant will earn 3% for a year of service during their first 20 years of employment. After that, 2% for the next 5 years of employment, and then 1% after 25 years of employment. So a participant that works for 30 years will generally receive 75% of their compensation through their retirement benefit. Each participant also receives a supplement of $200 per month if they retire prior to age 65, and will receive that supplement up until they attain the age 65. At that point, the supplement will no longer be paid. In the supplemental system, benefits are paid at the earliest of age 50 and 5 years of service. Again, the benefit is based on monthly average compensation determined in a similar fashion, looking at the highest 36 consecutive months of compensation. And the benefit is likewise based on a percentage that's determined based on the number of years of service. And 2% per year of service is earned in this plan for all years worked. There used to be a post-65 reduction to the benefit. That was eliminated in 2013. And similar to the fire and police system, there's a supplemental benefit of $200 per month payable up until age 65. Any thoughts or questions on the summary?
Base salary.
Can you just quickly, I'm sure I understand, but age 50 with 5 years of service.
Yep.
You're then eligible for retirement
Correct, in the supplemental plan.
in the supplemental plan, okay.
In the fire and police plan, if you work 20 years of service, if you work 20 years, you're eligible for a benefit irrespective of your age. So if you start at 25 and you work 20 years, you can start receiving a benefit at 45. Any other thoughts or questions? Okay, on page 8, just review some of the terminology that is critical to developing the contribution requirements. So the actuarial value of assets, that is, for lack of a better term, an average or a smooth value of assets. We look at the current value of assets as well as the previous 4 years and take an average of that. And the impetus behind that is that there's a lot of volatility in the market, and using an average hopefully will smooth out some of that volatility while smoothing out the contribution pattern, making it a little bit more knowable than it would be if we were to reflect all of the market volatility in the current year. The actuarial accrued liability is the present value of benefits that have been earned. So theoretically, if you wanted to settle those liabilities and no longer be responsible, that is the value that you would have to pay in order to do so. The unfunded actuarial accrued liability is just the difference between the assets and the liabilities, the amount that you, in theory, have to make up either through investment performance or funding the plan through your contributions. And the funded status is just another way of looking at that unfunded liability. It's just a percentage of the assets or the percentage of the liabilities that are covered by your assets. And then finally, the actuarially determined contribution, that is the amount that is determined on an annual basis in order to fund benefits that will be payable in the future. So that's the contribution, or what we used to refer to as the annual required contribution that's made on an annual basis. And how do we determine that actuarially determined contribution? On slide 9, there are two components. One is the normal contribution, which is the present value of benefits that are accruing in the year, the benefits that are earned by active employees. Given that there are so few active employees, that's really not a significant factor in the overall contributions. What really is the driving force behind the level of contributions is what we refer to as the accrued liability contribution, and that is an amortization of the unfunded liability. That amortization period phases down by 1 every year. It started at 30. This year we're amortizing the unfunded liability over a period of 17 years. Next year it'll be 16, 15, and so on. Some of the key assumptions that we use, we've been using 7.25% as both the assumed rate of return on assets as well as the interest or discount rate that we use to determine the liabilities. That's been in place, I think, for the past 5 years. And we also use the IRS mandated table, and this table is mandated for corporate plans, but we've been mimicking the IRS tables for the past 4 or 5 years as well for determining liabilities for the city system. So we're using the IRS 2019 table for the 2019 valuation. Lastly, as of now, there have been no cost of living assumptions reflected in the calculations for 2019. So no changes in benefit levels are reflected.
Sir, can I ask a question? Sure. What do you all see? I'm sure you manage other retirement plans. What do you see as a standard in terms of other plans providing cost of living adjustments? Do other plans typically do that? Is that a norm in the industry now? Is it not a norm?
So I think you have to kind of bifurcate it and look at governmental plans versus corporate plans separately.
Sure.
In the corporate world, it's very rare. We don't see it I won't say at all, but it's few and far between.
Sure.
In the governmental plan world, it's a little bit more common, but I think it's becoming less and less common just because of the costs that are associated with it.
Andre, can I follow up just a little more? Do you see a difference between closed pension plans, like ours, and plans in the government spectrum, and plans that still have active participants?
With respect to the cost of living?
Right.
Well, I don't know that I've seen a difference. In theory, I think I understand where your question is coming from. With an open plan, there's additional sources of contribution requirements. So that component of the contribution requirement that I mentioned, that was very small, the normal contribution, that's really driven by the active population. And with a closed plan, obviously the active population is very small, similar to the city of Portsmouth. It's only about 20, I think there's exactly 28 active participants across the two plans. So you really lose that component of the contribution because you're not being funded by, or there's no funding driven by the active population. It's really driven by the unfunded liability. So for that reason, I think to your point, Cheryl, there may be, at least anecdotally, there may be fewer plans that are closed as compared to those that are open that offer cost of living increases.
Andre, can I ask a couple of, this is Brian, can I ask a couple of questions on the assumptions, one of which is related to the COLA? Actually, I guess it's just a comment given some of the discussion around this. A lot of governmental plans don't specifically tie the cost of living adjustment to something like the consumer price index. They almost hard-code it in to say each year the plan is going to provide a 2 or a 3%, for example, cost of living adjustment to those that are taking benefits from the retirement system. And that would be irrespective of what the actual inflation rate is during any given year. So that's one thing. The question I had was with respect to the amortization period of the unfunded liability. You talked about the amortization period starting at 30 years and then scaling down by 1 year in the subsequent years. That's not a government sort of finance requirement, is it? That's just something that the city decided to do. Is that correct?
That's correct. So there are several different what we call cost methods, ways of recognizing benefits and the costs associated with them, and that is the approach that was selected by the city, I think, about 15 years ago.
Okay, thank you.
Sure. Any other questions? Okay, so we'll start digging into the results on slide 10, and what I did was summarize the results for the fire and police system first, and then after that the supplemental system will follow with similar depictions. So on slide 10, it's just a summary of the participation in the plan over the past 3 years. Participation is relatively static. What you will see is that the overall participation has declined because the plan is frozen to new entrants, and most significantly, the active participation has declined from 22 to 14 over the past 2 years. So as mentioned, that's going to, the actives are really driving much less of the contribution requirements than are the inactive population. The next page summarizes the two different types of assets that we look at in determining the contributions. So the market value of assets, that's the value you would see if you were to open up your trust report. As mentioned, we use a smooth or an average value of assets, and we call it the actuarial value of assets. One of the things that I always review just to see how the assets are performing, at least in comparison to our assumption, is whether or not the market value of assets is lagging the actuarial value of assets. So generally, when the market value of assets is lagging the actuarial value of assets, that means over the past 5 years that investment performance hasn't hit our assumption of 7.25%. So that means that there are some investment losses that are being deferred and will factor into that actuarial value of assets in future years. So to kind of explain that a little bit further, you can see in the final row of the column that's titled 2019, the return on assets was about 7.4%, but because we are factoring in investment losses that had been previously deferred, I made a note at the bottom of the page in bold that the return on the actuarial value of assets, the assets that we're using to determine the contributions, was 4%. So it's those deferred losses that we're bringing into that actuarial value of assets that depressed the return on assets. Questions?
Andre, we always, I think it's been about 5 years since we dropped that discount rate from 8% to 7.25. And we had discussed at the time that we would consider this going forward, that as, you know, as time goes on, all you're doing if you have that higher discount rate is deferring some of the cost to a later date. And I think it's, again, we need to come together as a board in some time and discuss this discount rate and what's most plans using corporate versus government, and see if we can adjust that to strengthen the plan in the future.
Is that a question or?
Yeah, that's
For
kind
me,
of an open-ended
me
question.
specifically.
Yeah.
So, and I may defer to Brian a little bit on this. I think for municipalities, governmental plans in general, 7.25% is kind of right in the sweet spot. When we look at corporate plans, 7.25% would be a little bit more aggressive. In the corporate side, I would say the average is probably around 6.5%. It's been trending down pretty significantly over the past decade or so. When I'd say about 10 years ago, it was typical to see rate of return assumptions in the 8.5% range in the corporate world. Now you typically don't see an assumption over 7%. But go ahead, Brian.
Yeah, I was just going to agree with your comments. I think last time we looked at this on the government side, 7.25 was actually the median expected return assumption that was used by plans across the U.S. And Andre's right, that number has been coming down over the years. But increasingly what we're seeing as well is plans setting return assumptions even below 7%. So, I think probably around 6.75 or so, but 7.25 is still a good number. It's right in the middle of what everybody else is doing.
Can I just make one comment? So, if we believe based on our asset allocation that 7.25 is a reasonable expectation for long-term returns, I think we should probably leave it there. There's some sort of negative ramifications from a reporting standpoint for using a lower discount rate, and Cheryl can probably elaborate on that. But if you use a lower discount rate, it's going to make the liability that we report higher, and therefore the funding deficit greater, which from a sort of balance sheet standpoint of the city, that's not good.
And that is correct, Mr. Moore. I will say, this is a time of year where the city finance is pulling together the information for our annual financial statements, and we have a number of actuarial studies. We of course have this one for the closed systems. We have the VRS studies, and then we also have some that relate to healthcare, and I have seen one of those go down this year to 6.5%, and I believe it's the VRS system. So so they made a decision to use a lower discount rate this year, and that's just as a point of information that that we are seeing that, and the city has to cover just like with the closed system, we cover the full amount of the contribution, the actuarial determined contribution for VRS. We cover, we now, and this was a fairly new reporting standard, is we have to report the deficit of our percentage of VRS. So it's very different than the 100% of the closed systems. But so our percent, our liability, is for VRS this year is based on a lower expected return.
And I don't know what the asset allocation is for the VRS system. They may have a different asset allocation than us, and justifiably may have a lower expected return. Brian, in your sort of view, do you think 7.25 is still sort of reasonable from an investment return standpoint?
It is, Landon, based on our sort of long-term assumptions, which is what that number is typically based on. Now, that doesn't mean we're going to hit 7.25 every year, and in fact, we think over the next, maybe call it 3 to 5 years, it's probably going to be a little bit less than that. But say over the next 10 to 20 years, we think 7.25 is very, very much achievable, given the asset allocation we have. And just a quick comment on Landon, your comment earlier about this being a really important assumption because it has implications for everything that goes on here, not only in terms of how we allocate assets, but also what the cash contributions would be required of the city. Andre, refresh my memory. For let's just call it a 1% decline in the expected return, the liabilities would go up something like 10%. Is that a good kind of rule of thumb here?
Yep, about 10-11%.
Wow.
Yeah. So what that means then is the actuarially determined contribution goes up, more contributions sooner from the city would be required. Now, the implication of not, if we leave it at 7.25, which again we can support, and it's we wouldn't suggest that number be changed. But let's just, for argument's sake, say that 7.25 is not achieved. What does that mean? Well, it means the city's going to have to kick in more contributions, but they do it sort of at a later date. So whether you change the assumption or not, just really determines the timing of the contributions, doesn't necessarily determine the magnitude of contributions, if that makes sense.
Thanks, Brian.
Yep.
Any other questions on those pages? Okay, so before reviewing the assets in comparison to the liabilities, slide 12 just shows a history of the cash flow for the system. And I will highlight the year 2017. And before doing that, just a brief explanation of what this chart really represents. So the items or the bars that are above the zero line or a positive represent inflows into the system. Those that are below, like benefit payments, represent outflows of the system. And then the shaded red area represents the net inflow or outflow, whether cash flow is positive or negative for a particular year. And as you can see, every year except for 2017, the cash flow was negative, and that's primarily a function of the contributions being so significant with respect to the size of the plan. But in 2000,
Payments, you mean?
I'm sorry. Did I say
Yeah.
benefit payments being so significant with respect to the size of the plan.
Right.
But in 2017, where we had close to 11% return on assets, we did have a positive inflow into the plan, but it took, again, a double-digit return. So really does highlight the significant impact that benefit payments have on the funded status of the plan and the overall inflows or outflows into of the assets. Questions?
And I just want to ask a question, just basically looking at 2019, just as a general. So the investment return was 11.4 million.
Correct.
The benefit payments, those were the actual benefits that were paid out.
To the participants.
Was 22.1 million.
Correct.
So we take that as and then there's the contributions were 7.5 million. Okay. So the in net cash flow is 3.2 million. So I guess if you add those two up, that's where you get those two. I'm just asking the question. The two you add up there.
So you're pretty much adding the first three items,
Right.
and that results in the net cash flow.
Correct.
Which
Gotcha.
is it's a negative, so the asset base decreased by $3.2 million.
That's right. Got it.
It's safe to assume that moving forward, that benefit payment will decrease slightly each year?
That's the assumption.
Yeah.
As folks pass away and no longer receive
Right.
benefit payments, and there aren't many people that will start receiving benefit payments in the future, that the benefits will decrease. And I do have some projections later in the presentation that will highlight that.
All right.
Yeah, so just a little bit of perspective, the 22 million in benefit payments is about roughly 10% of the assets. So between the contribution investment return, just to keep up, we have to return at least 10%, which we already talked about. The 1 year we returned 11% to have a positive cash flow. So it's a pretty high hurdle.
And Landon and Councilman Battle, this is exactly the conversation that we had at the City Council meeting last month.
I mean, Councilman Glover.
Yeah, it's Councilman Glover, Brian.
I'm sorry, Councilman Glover. I'm sorry.
That's all right, Brian.
Yeah, so what we'll see, and the contributions will depict this to a certain degree, is as that in the future, as the amortization period continues to decline, so we're at 17 years now, 16 next year, and it'll continue to decline, the contributions will get more significant, and the benefit payments will start to shrink, and that will help reduce your funded status or the funded deficit. And then eventually, it will level off.
But the key you said there's contributions will become more significant.
Yes, they will increase unless there's better than anticipated asset performance.
Sure,
or the
absolutely.
liabilities
Absolutely.
decline by
But the
more than we
likelihood
anticipate.
is they will increase.
Correct.
And there's a projection in here, I think.
Yeah, Andre's
Yep.
he'll go through that in just a minute.
Thanks.
So on the next page, slide 13, a comparison of the actual value of assets, again, the assets we use for determining contributions, to the actual accrued liability. And here we show the funded status, or the percentage of assets or liabilities that are covered by assets. And you can see that that's trended down from 72% as of July 1, 2017 to 67%. Or 67.8% as of July 1, 2019. I think more importantly, on the next page, instead of looking at it as a percentage, we look at it as a dollar value, the unfunded liability. And we've seen that increase over the past few years from $67.2 million to $76.9 million. And that's that's really the component that's going to drive the contribution most, that unfunded liability that's going to be amortized over the next number of years. And we can see how that translates on the next page, slide 15, to the actuarially determined contribution. We were at $6.5 million in 2017, $7.2 million in 2018, and for the 2019 plan year, or fiscal year ending 2020, the actuarially determined contribution is just $7,658,000. Any thoughts or questions? So I will note that the increase in the contribution requirement from 18 to 19 was less than it was from 17 to 18. I think we had about a 12% increase. Last year, the increase is about 5 or 6% this year.
And Andre, do you have a sense as to, so the liability has increased over the last 3 years, and there's really two primary pieces that would drive that. It's the investment returns maybe lagging the 7.25, but it's also the change in mortality assumption that you're making. Do you have a sense as to the relative contribution to the increase between those two?
Yeah, so if we go back to slide 13, at the bottom of the page, I made a note about what's driving some of the asset losses, or I should say the difference, so the change in the unfunded liability. And the most significant portion were asset losses. Again, from the actuarial value of assets grew by 4%, or the return on that number was about 4%. So that resulted in a asset loss of $5 million. The asset value was $5 million less than what we anticipated, assuming a 7.25% return. We also had a liability loss, meaning the liabilities were greater than anticipated. And there were really two components of that. One was the updated mortality table. We updated it from the IRS 2018 table to the 2019 table. And then there's some demographic changes. We always assume certain demographic changes over the course of the year. They're always going to differ from our assumption. That contributed a little bit as well, but a very minor component of the liability loss.
And then just a quick comment on the asset side. Obviously, 4% isn't a good number, particularly when you're shooting for 7.25. But keep in mind, this period captures or reflects the decline that we saw in the fourth quarter of last year. Yep. Now, markets have recovered since then, but the volatility that you experience in those big drawdowns makes it really challenging to recover from. Which is why, the actuarial assumptions smooth things out in terms of the assets over time to get rid of that volatility, because we know we're not going to hit 7.25 each and every year, and in fact, even when markets are good, that number might not be achieved if there's significant levels of volatility that occur within that 12-month window. So. Just a comment that it was a unique, I guess, period of time this last plan year that included a pretty significant drawdown.
And again, just to be clear, the 4.1% is the return on the actuarial value of assets. The return on the market value of assets was actually really close to our assumption. It was 7.4% compared to the 7.25% assumption. So even in spite of that volatility, Brian, the returns were actually closer to our assumption than they have been in a while.
Yep.
I'd like to add one thing. We just to confirm, we did budget significantly enough. I mean, we budgeted enough to make these payments this year. So we won't have to go back to City Council and ask for additional money. Of course, we budgeted, because we had a high increase last year, we budgeted a high increase this year. But there is enough money budgeted to make this contribution.
Thank you.
Okay. So those are the results for fire and police. Any questions on any of the information presented before moving on to the supplemental system? And the supplemental results start on slide 16 with a summary of the participation, similar to the fire and police plan. The participation is relatively static, but we do see it declining since the group is closed. Notably, the active participation has declined from 18 to 14 over the past 2 years. Moving to the next page, a summary of the assets that we use to determine the contributions. Again, the market value in comparison to the actuarial value, and I look at whether or not the market value is trailing the actuarial value, and it is. And I should have noted when we were looking at the fire and police, one of the trend lines that I also look at is the difference between the market value and the actuarial value of assets. You can see in 2017, the difference was about $2 million in the supplemental plan, and it's only about $900,000 now. So that means we're actually trending in the right direction. The market value of assets doesn't lag the actuarial value by as much. So much of the unrecognized losses that had been deferred have been recognized at this point, and there aren't as many significant losses to be recognized in the future. So that's a good sign. Thoughts or questions? Page 18, again, a summary of the cash flows, and this slide depicts a similar story to what we saw under fire and police. Again, the cash flow, whether it's a net inflow or outflow, is dominated by the size of the benefit payments in relation to the size of the plans. And in 2017, where we had those double-digit returns, where we had a net inflow into the plan in fire and police, it's a small net outflow into the supplemental plan. But again, this just highlights the importance of the size of the benefit payments in relation to the size of the overall asset and liability base. Slide 19, a history of the funded status. Similar to fire and police, the funded status has declined, in this case from just under 76% to just under 71%. But turning to the next page, we see a little bit of a difference in the trend line. So whereas a percentage, the percentage has declined over the past 3 years, we have seen an overall increase in the unfunded liability from 2017 to 2019, but really no increase from 2018 to 2019. So the unfunded liability has been flat, meaning that the increase in contribution in the supplemental plan wouldn't be as significant as what we saw in the fire and police plan, since the unfunded liability increased from 2018 to 2019 in the fire and police plan. And again, it's that unfunded liability that's really driving the cost, because we're amortizing that over a period of time. So turning to the actuarially determined contribution, while it did increase by about $400,000 from 2017 to 2019, $1,867,000 in 2017 and $2.2 million in 2019, the increase from 18 to 19 was relatively small, just under $2.2 million in 2018 to just over $2.2 million in 2019. And again, that's really driven by the unfunded liability being flat year over year. Questions? The next section is just a quick analysis of what a cost of living increase as effective July 1, 2019 would cost, how that would translate into the actuarially determined contribution. If we were to implement a 0.5% cost of living increase, meaning that the benefit for all members that are currently in receipt of a benefit would be increased by 0.5 percentage point. That would increase and this is for fire and police specifically, that would increase the actuarially determined contribution by $109,000. And that's not just a one-time increase, but all assumptions being met, the increase in the actuarially determined contribution would increase by $109,000 over the coming years as well.
And Andre, could we use that number, that's a 0.5%, to calculate any other
Yes.
changes? So if we wanted to do 2%, it would be 4 times this.
Correct. Similar numbers for the supplemental plan. 0.5% increase in the benefits would translate to an annual increase in the contribution of $34,500. And again, that's not just a one-time increase, but over the coming years. Okay. So I mentioned that we had some projections that were prepared. And this really shows the trend, or at least the expected trend, of the liabilities in comparison to the assets, and most importantly, I think the contribution amounts. So this slide 26 is for the fire and police. The line graph in dark blue represents the funded status, the percentage of liabilities that are covered by the assets, and the light blue bars represent the anticipated actuarially determined contribution. So consistent with what I mentioned previously, we do anticipate the contribution amounts to increase in the coming years and then level off after about 6 or 7 years. And again, this is really based on our assumptions being met. liabilities growing or decreasing in accordance with our assumptions, and investment performance also meeting our assumptions. Any deviation from those assumptions obviously will result in the contributions as well as the funded status deviating from what we've depicted here. So you can see the funded status is expected to decline from the 68% to about 65.3%, and then start increasing at that point forward, and that aligns with when we expect the contributions to level off as well.
Beyond the 10-year period here, we would expect this curve to continue to move up.
Yeah, the funded status should continue to move up. The number of the amount of benefit payments should decline, and you can see that starting to be the case in about 2000. Actually, next year we're expecting the benefit payments to decline. Again, that's an expectation. But in conjunction with the benefits payments declining, the contributions increasing, at least over the short period over the short term, that contribution amount is anticipated to level off.
Brian, are you still here?
I am, yep.
Okay, are you on the page 26 with us?
Yes, sir.
Okay, is it, based on what you said earlier, is this what we're looking at, that we'll probably have a soft economy for the next few years and then it should get stronger, therefore we could average out a 7.25 return?
Yeah, unfortunately, the way things work and the assumptions work is to the extent you have a year where we don't hit the 7.25, that shortfall relative to the 7.25 sort of compounds through time.
Right.
Is that right, Andre?
Yeah, that's absolutely correct. So to your point, Brian, if you don't return 7.25 in a particular year, to get back on schedule, you're obviously going to need to return a lot more than 7.25, or maybe not a lot more, but more than 7.25 the following year. You're going to have a smaller base to start with than was anticipated. So it will take, returns that are more positive than would have otherwise been anticipated in order to make up for that short-term underperformance.
I guess the other way to sort of answer your question, I think that was, I'm not quite sure, David, was that you that asked the question?
Yes.
If we enter, let's say, over the next 3 years, a period of sort of a softening economy and below long-run capital market returns, that line that you see that shows the funded status is probably going to decline a little bit more steeply.
Okay.
But it still holds over a long period of time that at some point when the benefit payments decline significantly enough, that we'll see the trend line and the funded status begin to increase.
So you're comfortable with the fact that within in the next 10 years, we will reach a 70% funding?
I think with over the next 10 years, that over that full period of time, we would be comfortable with capital market returns looking normal and being able to sort of support that 7.25% return. Yeah.
Okay, thank you.
One thing to note, that these calculations do not include the additional funding that's anticipated from the refinancing of the obligation bond. This is just based on the required or the actuarially determined contributions that would be funded into the plan.
So that actually makes things a little bit better.
You would assume so.
And the first contribution's coming soon, is that right? Or
I believe it's February.
February?
Yes, sir.
So Andre, that additional contribution that's coming really has two impacts, right? It all else being equal, would improve the funded status because there's more money coming in, and the sooner it comes in, the bigger the impact it has on the funded status. But it would, because the unfunded liability goes down, then the ADC would come down as well. Is that right?
In theory, but in the discussions that I recall, I believe that the desire was to carve out the additional contributions or the additional funding from the obligation refinancing when determining the actuarially determined contribution.
Got it.
Cheryl, I don't know if you can
That is
confirm
correct.
that.
That
Okay.
is correct. Yes, that
So the new money coming into the plan, when it does come into the plan, should have a relatively significant impact on the funded status.
Right. And I guess to further explain that, so when we're looking at this projection, the funded status would be improved as a result of the additional monies, so that blue line would trend up a little bit more quickly, but the contribution pattern should not change, because we're going to carve out that additional funding when determining those contributions.
I would, just want to point out for the record that we're looking at a $1 million increase in, is that right? The ADC is going to increase from the 7.7 in this plan between now and 2025 by $1 million.
That's correct.
Before it starts stabilizing.
That is the assumptions.
Yes. See that.
Turning to the supplemental system projections on the next page, we see a similar story where the funded status declines. Maybe a little bit, at least depicting here, it might look like it's a little bit more precipitous, with the actuarially determined contribution increasing and then leveling off. Cheryl, to your point, the supplemental system, it increases by $500,000 over the next 4 years and then levels off, or at least that's what we're anticipating.
What are the factors between the two systems that's causing the fire and police system to actually get better over the later period of years than the supplemental system?
Yeah, so I believe it's the fact that in comparison, I should say the benefit payments are a more significant component or a significant percentage of the asset and liability base in the supplemental system than it is in the fire and police system. So that those significant benefit payments are drawing down the asset values in the supplemental system at a faster rate than they are in the fire and police system. We're just starting with a higher asset base in the fire and police system. So we're not seeing that precipitous decline in the percentage in the fire and police system that we are in the supplemental. Any other thoughts or questions? So I think that covers it for my prepared remarks. And I will turn it back over to you, Landon.
Thank you. I believe that is everything we have on the agenda.
Yes.
Meeting adjourned.